Hi everyone, welcome to today's video. On today's video, I will discuss with you specific profits that I made in the last 1 year in the stock market. I will show you the proof. More importantly, this is an educational video and I will discuss 5 specific strategies that I used as a normal retail investor to make this money. Very quick set of disclaimers. Number one, this is not an investment advice. You have to figure out your own strategies. Number two, the idea for me by shooting this video is not to brag, but to actually tell you that normal retail investors can make a lot of money in the stock market if they play sensibly. Number three, these are my realized profits that I'm talking about. By realized profits, I mean that these are profits that I have booked. So there are a lot of stocks that I have not sold yet because I mostly do not sell my stocks. Very rarely I sell my stocks. And the money that I'm showing you is the money that I made in the last 1 year by selling stocks. So realized profit means that the profit that I've already booked. Also, a very quick shout out to our sponsors for today, which is Ditto. I absolutely love their product. You can actually go and speak with an insurance expert for free. Absolutely free. Understand your insurance requirement and then purchase your insurance. So you're buying insurance sensibly. Check the links in the description box. You can use that link to schedule a free phone call with an insurance expert. They will sit with you. They will help you understand all the points related to insurance. How much cover to buy? What are some of the things that you need to keep in mind? Accordingly, take insurance. It's super important to do that. So with that said, let's get the video started. And let me first and foremost tell you about my profits. You can check from my Zerodha portal that this is the money that I made on one of my accounts. And these are realized profits that I'm speaking about. Now, a lot of people would have dropped off because this answered the question, but now comes the serious learning part. This is the learning that you can take away, implement, and hopefully make similar amount of profits. Okay, so with that said, let's jump right into the video and let's discuss strategy number one, which is risk hedging strategy. Now, there are 100 different ways in which I hedge risks, but there are 3 important points that I would like to leave you with. If you enjoy it, press the like button. That will indicate to me that you would want me to make a specific part dedicated to risk strategy. So I'll do that. So my first key point that I will leave you with is that please be considerate about alpha and beta type of stocks. Now, what are alpha beta stocks? Alpha means absolute returns, right? Absolute returns. So this could be, for example, in a year's time, let's say Hindustan Unilever gave 15% return, hypothetically speaking. So that is the alpha of the stock. Now, what does beta of a stock mean? Beta means the volatility of the stock. Now, what is volatility? Volatility in simple terms means that if the index moves by, let's say, 10%, right? It moves up by 10%, then the stock that you're considering, let's assume HUL, it moves by only 5%, right? In an upward moving market. On the flip side, if the index falls by 10% and if the HUL stock falls by 10%, then it is protecting your risk. So this is the beta or the volatility of the stock. So what I tend to do is that if a stock has a very high volatility, but if it is not giving a very high alpha, then there is no point in buying such stocks. So let me explain that via using an example that I've used on some of my previous videos about L&T. If you check the long-term beta of L&T, you will see that the long-term beta of L&T is 1.2. So what does this mean? A beta of 1.2, it simply means if the stock market rises by 100%, then L&T stock should rise by 20 additional percent. So it should rise by 120%. On the flip side, if the stock market, which is Nifty 50, falls by, let's say, 100%, then it is okay for L&T to fall by 120%. So that is the concept of beta or volatility, that in a good environment, highly volatile stock should give you higher returns. And in a downward falling environment, it is okay for the high volatile stock to fall even more. Not a problem there. But here is the problem with L&T, and if you check the 5-year return for Nifty 50, you will see 110.51%, right? If we check L&T 5-year return, you will see it at 104.55% over a period of 5 years. Now, is this bad? Absolutely. It is very bad because your risk adjusted return for a stock like L&T is really bad. Now, some of you might have made money, etc., but from a systematic purchase point of view, never buy these type of stocks. It just doesn't make sense. It is a highly volatile stock and you're not getting adequate compensation for taking that risk. That is the technical understanding behind it. So in simple terms, if the alpha and beta are not justified, then there is no point in buying these type of stocks. Now, let me very quickly touch upon a couple of additional points, which is around buying sensible stocks and analyzing the risk reward equation. Now, in terms of sensible stocks, so I only tend to buy stocks that I can afford to hold and I understand the volatility that I'm purchasing, because many a times what happens is that even when you purchase a really good stock, let's say HUL or HDFC Bank, they can fall. For example, HDFC AMC has fallen from its peak by roughly 35% right now. Is that a bad stock? No. Would I have been okay right now even if I were sitting on a loss of 35% on HDFC AMC? The answer is yes. So that, according to me, is called as sensible stock buying. Now again, you can go have your own methods around it, but I would never purchase stocks in bulk where I would lose my sleep, right? So from that perspective, I will always do sensible buying where I'm okay temporarily losing some amount of money because I understand that this money will come back. So I do not work with stop losses. I do not put stop loss, this, that, because all that is just headache oriented stuff. And I, as a normal retail investor, would not have the time to do all that. Therefore, majority of my money is put in sensible stocks only. Which brings me to part 3 of this strategy, that always purchase a stock by analyzing the risk reward equation. Now, what do I mean by that? For example, right now, if we pick the example of Punjab National Bank, right, or if we pick the example of SAIL. So what is happening here is that the book value of the stock is higher than the current market price. You can check it here. So here the book value of the stock is much higher than the current market price, and there is no fundamental problem with these two type of companies. So this is called as analyzing the risk reward equation. Does it make Punjab National Bank, SAIL brilliant stocks? Are they brilliant growth stocks? Will they become like multi-baggers in the coming years? No, I am purchasing these at such a low price right now, and I'll sell them when they hit their book value, and I will still make great profit on it. So that is called as analyzing the risk reward equation. So these are some sensible risk hedging techniques that I use. You can go try it out. Are these the only risk hedging techniques that I use? The answer is no. Will I be teaching you more risk hedging techniques? The answer is absolutely yes. Do hit the like button and help us reach to 20,000 likes on this video, and I'll definitely shoot part 2 of it. So my last video on explosive stocks did really well. Thank you so much for the likes and comments. And sticking to my promise, I'll definitely release part 2 of that video. So over to the next strategy. So the second strategy is buy low, sell high. Now again, there can be an entire series that I can build around this particular concept, but let me explain 2-3 very quick important points. One is that there is a lot of talk about catching falling knives, right? You must have heard of the phrase that, you know what, if the stock is falling down, don't catch it. It's like a knife. If you catch it, your hands will get cut, blood will come out, this, that. Is it true? I don't think so, because if you're not willing to purchase stocks when they are falling down, or if they are already at a beaten down prices, how will you make money? So you'll not make money. Important point to remember in terms of catching a falling knife is that you must understand first and foremost why the knife is falling. If the entire market is falling and if some stocks fall along with that, there is nothing wrong with that stock per se. Right now, for example, a lot of stocks are available at a discount. For example, HDFC AMC, for example, HDFC Bank, for example, Kotak Bank, for example, ICICI Bank. All these are falling knives. Technically, yes, these are falling knives. But are these stocks never going to come back? The answer is no, they will come back. So what does common sense tells us? The common sense tells us that we should actually purchase these type of falling knives. If you don't purchase these now, how are you going to make money, right? So from that perspective, please be sensible in terms of catching that falling knife. You should not go around purchasing any random stock when it is falling. I absolutely agree with the point of view that you should not catch falling knives on really bad stocks. You should not do that. That does not make any sense. But if some really good stocks are falling, for example, in the 2020 COVID crisis, Bajaj Finance was falling. I traded that stock like crazy. I must have taken like 6-7 swing trades on that and made like insane amount of money. But I did that on a good stock. So always remember that catching this falling knife theory is applicable to bad stocks. You have to catch falling knives when good stocks are falling. Otherwise, you will not make money. Now comes the second key point, that you must understand the basics of technicals in terms of purchasing stocks. I have talked a lot about support and resistance, that you must understand that what is the support level, what is the resistance level. You don't need to use all the indicators, but at least understand the basics of it. So let me show that to you via an example. Now here is the example of HDFC AMC. This is a very strong resistance level, right? Very, very strong resistance level. Why? Because look at the number of times HDFC AMC stock has touched this line, right? Numerous times. This is a very, very strong resistance level. And this is a very strong support, right? Very, very strong support. So this is the support line, right? This is the support line. Now, as we are sitting today, this stock touched the support line and it is back up. Still, from its resistance, it is still very, very much down. And from its resistance line, this stock is still down by roughly 18-19%. So this is a good gain to be made. At some stage, this stock is going to come back up, very hopefully this year itself, and you will get 20% gain. trading sensibly in a decent stock. So I don't think that this is a major problem from that particular perspective. Also, another simple indicator to check, even if you don't understand much about technicals, is 200-day moving average line. You can put this indicator of 200-day moving average by using TradingView, and you can see this blue line, right? And the stock is still very much below this blue line, and a lot of profits can be made if this stock returns to its blue line or the 200-day moving average line. Super simple strategy, anyone can execute. Now, the third and final piece that I will leave you with is the concept of zone of bulk buying, right? Now, I've made a separate video on this topic. You can go and check it here, but very, very quickly, let me illustrate this point by using the example of Hindustan Unilever. So this is your resistance line. This is your support line. This is a very strong channel. And if the stock breaks this particular channel after a very long period of time, this enters into ZOB, right? Zone of bulk buying. Purchase these stocks in bulk. So that is what I have done it. This is not a stock buying recommendation. Please do it at your own behest. What is the meaning of behest? Please Google it. Word of the day. So this is zone of bulk buying. Use this to make money, and also comment below which other stocks you see in zone of bulk buying. That will help our other audiences as well. Now, the third specific technique or strategy that I have used is never run after a rising stock. If the stock has given massive run up, just leave it, let it consolidate or fall. Once it falls or consolidate, then go and buy it if you're in love with that stock. Okay, so let me take you to an example. So I made a video on Tata Motors, so I'll use that as an example to illustrate this point. So from its bottom, the stock was up by 95% roughly. Right? The stock was up by 95% roughly. Then it has started to consolidate or come down. If you take a 1-year view of Tata Motors, you will see that the stock is up by 150%. So which is a massive run up on this stock. And why the stock run up has taken place is simply because of the fact that there is a lot of EV based narrative that all the conventional vehicles are going to move to EV and Tata Motors will become a leader in this. I'm not saying that Tata Motors is a bad company. It's a very good company. No doubt about that. But people are buying into this narrative that, you know what? Tata Motors is the next big thing and it will have no competition whatsoever. No, that is not correct. In fact, if you check the leading EV maker in the world, which is Tesla, even its owner, which is Elon Musk, he himself has cut his stock. Now, I'm not trying to stir a debate here. He has cut his stocks on Tesla for a wide range of reasons, and one being that he himself feels that Tesla is overvalued at this stage. Important point as retail investors is that if you analyze this thing where a stock has given a massive run up very, very recently, and if you go and purchase when the stock is rising, it can create a lot of problems for you and majority of the equation. The risk reward equation does not make sense. Therefore, you should avoid doing it, in my opinion. It's okay if you miss the rally. There are 100 different rallies that are going on. You can't invest in every single stock that is giving a rally, right? So from that particular perspective, please be sensible and please try to avoid it. If you're in love with that stock, if you still feel that, you know what, Tata Motors, lot of steam left, lot of returns to be made, wait for it to consolidate. For example, right now, Tata Motors has started consolidating and it is already down by 10%. Now you can start taking a little bit of positions rather than trying to catch it when the stock is moving up. Now comes the fourth point, which is adopt different styles of investing. Now this is such an important point, and let me try to communicate it in the simplest way possible. So when we speak about Charlie Munger or Mr. Warren Buffett, what style of investing do they have? They are value buyers for cash flow based businesses. For example, Mr. Warren Buffett has a big portfolio in Apple, Coca-Cola, Walmart, all these different type of companies. And in his prime, these were the type of businesses that existed in the world. I really respect Mr. Warren Buffett. I have learned a lot of things from him. But sometimes people become like fanatics that, you know what, because Mr. Warren Buffett does this, I'm only going to adopt this strategy and everyone else is wrong in the stock market. Yes, Mr. Warren Buffett has made a lot of money in the stock market. He deserves all the respect. I personally respect him a lot. But the assumption that everyone else who takes an opposing viewpoint to Mr. Warren Buffett is wrong, that is incorrect. Please don't discount everyone else's perspective. For example, Mr. Mohinish Pabrai or Mr. Vijay Kedia has a very different style of investing compared to Mr. Warren Buffett. Mr. Vijay Kedia or Mr. Mohinish Pabrai, they are deep value investors. They go and invest in companies where you and I can't go and invest because we'll get scared. I will personally get scared. I will never buy these type of companies. It looks super scary to me. These companies are not giving any basic cash flows also, but are available at a very attractive price and they are going and investing there. So that style of investing does not work for me. Similarly, there are a bunch of new age investors. So you need to pick up their commentary, understand their viewpoint, and accordingly build your own perspective on investing. So this is where I will talk about one of my favorite movies, which is Karate Kid. And there is a show also, Cobra Kai. I watched that. In case Cobra Kai fans, hit the like button. So there is a coach and his name is Mr. Miyagi. So Mr. Miyagi coaches a student and his student's name is Daniel San. So basically he coaches Daniel and he was teaching him about a bonsai tree. So there are 1,000 different ways in which a bonsai tree can grow. There is no standard definition of a bonsai tree that, hey, it should grow only in X way or Y way or Z way. It can grow literally in any fashion. This is what a bonsai tree looks like. So depending on how you want to grow your investment style, which is a bonsai tree for you, you need to grow it by picking good investment styles by different people. So I'm saying it in the nicest way possible, that I deeply respect Mr. Warren Buffett, bunch of other different people, but that does not mean that I 100% need to agree with them all the time. So the bottom line being that you need to mix and match your strategies, understand what you can pick from each of the investors. For example, if you start picking crypto narratives from traditional investors, that is not their style of investing. It is like trying to learn batting from Jasprit Bumrah. Jasprit Bumrah is a great cricketer, but he will be able to teach you more about bowling compared to batting. So I hope that example makes sense, and I hope that you take this in the right spirit. Now comes the final point, that in order to make money in the stock market, you must do sensible selling. I had come out with a video on 3 stocks that I sold earlier, and one of the stocks that I have spoken about was RBL Bank. Since the time I had made that video, RBL Bank has fallen by roughly 50%. You can check my video here somewhere. Now, what was the reason that I sold RBL Bank? Mostly I sell stocks when market conditions or market dynamics change, or stock conditions or stock dynamics change. In RBL Bank's condition, what was happening is that when I made a decision to sell that stock, much better stocks were available at deeply discounted price. So I sold RBL Bank. I picked up that money, invested in Kotak, ICICI, HDFC Bank. Why should I take exposure to something like RBL Bank, which is not a growth stock like Equitas Small Finance Bank? Neither it is a stable stock like HDFC or ICICI. Similarly, I decided to sell OFSS and I sold it at a good profit. Now, the reason again I sold that profit was because a lot of US tech growth stocks are available at deeply discounted prices. So I would rather pick that money and invest in US based tech stocks. So that is how I rejigged my portfolio. Now, as normal retail investors, it becomes really difficult for us to figure out internal stock dynamics, because by the time we figure out that, you know what, there is something wrong with Ujjivan Small Finance or something wrong with RBL Small Finance, the stock price would have already tanked by 20-30%. Which brings me to the final point, and which comes from one of the core people that I follow, which is Mr. Ray Dalio. So his sensible way of investing is, please stay diversified. When I tell people that, you know what, I have 60, 70 stocks in my portfolio, people say that, you know what, actually you're mad. There is a reason why I have 60, 70 assets in my portfolio, because of the fact that A, I want to stay diversified. Number 2, I buy a lot of similar stocks. For example, something like HDFC Bank, ICICI, Axis Bank are similar stocks for me. It's not as if that I feel that one of these stocks will fail. All 3 are good stocks from time to time. One will get ahead in the race in other, but if you look at the macro narrative, there is hardly any major difference between these 3 organizations per se. So I'll have all 3 of these organizations in my portfolio, and accordingly I create and curate my portfolio. Roughly, I can club these 3 stocks as one stock only, and I will keep on adding and subtracting my position depending on how these 3 stocks are moving. So I hope that you understand and implement, more importantly, implement these 5 specific points and refine your strategy of making investments in the stock market and grow your own bonsai tree in terms of refining your investment style. Also check the links in the description box for Ditto. It's a fabulous company. Do go and speak with insurance expert. Very, very important for all of us to have insurance. And with that said, press the like button. Would make me super happy, and I will see you the next time.